Hello everyone. A while ago, I had read a paper by Professor Michael Mauboussin. The paper was titled 10 Attributes of Great Fundamental Investors. So, when I read this particular paper by Professor, I was not able to digest the entire paper in one go. And I had to read it a couple of times to understand the meaning of a lot of things which the professor had to say. However, in this particular video, I would like to simplify the 10 attributes of great fundamental investors. So, attribute number one is titled as Be Numerate and Understand Accounting. So, what does this mean? Great investors tend to have a feel for numbers, percentages, and being numerate is a common attribute of good investors. Having an intuitive understanding of accounting and financial statement analysis is a primary thing which a great investor has. There are twofold applications of financial statement analysis. One is the translation of financial statements into free cash flows, and the second is to understand the link between a company's strategy and how it creates value. So the ROIC calculation has been elaborated a bit in the paper. So the return on invested capital can be broken into two chunks. One is the profitability chunk, which is the net operating profit after tax divided by sales, and the second chunk is the capital velocity, sales divided by invested capital. So there are a couple of examples. So companies which have adopted a differentiation strategy tend to have higher profitability and lower capital velocity. These are companies which have high ROIC as a result of higher profitability. And then there are a few companies which tend to have lower operating margins, but they have high capital velocity. So these are the companies which have high ROIC due to higher capital velocity. These firms are usually the firms which have adopted a low cost model. And there is also confusion between research and development and capital expenditure. So good understanding of accounting will help an investor to adjust the financial statements, because many companies tend to expense the R&D expenditure, research and development expenditure, in the income statement. However, an investment in these research and development activities is bound to give yield over the years. Hence, the first attribute of being numerate and understanding accounting is an important attribute of a great investor. So, moving on to attribute two, understand value, present value of free cash flow. So, present value of future free cash flows is immutable. Almost all other factors tend to be mutable or subjected to change. However, computing free cash flow and understanding the durability or sustainability of these free cash flows is an important focus of great fundamental investors. Factors such as industry dynamics, competitive position of the company, barriers to entry, the basic economics of the business, and the capital allocation skills of the management are other important aspects of this particular exercise. Great investors also tend to understand the limitation of valuation approaches such as price to earnings and EV by EBITDA. Though these are shorthands to a valuation process, and these shorthands tend to have blind spot, and great investors are well aware of this particular aspect. So, as Al Rappaport has said, cash is a fact and profit an opinion. So, this particular statement stresses on the importance of analyzing the free cash flows. Moving on to attribute number three, properly assess strategy or how a business makes money. So, great investors tend to have a fundamental understanding of how the business makes money. The idea is to distill the business to basic unit of analysis, which varies from industry to industry. They also have a grasp on the changes in drivers of profitability, which can again be very subjective, and it can be varying across industries. Great investors also tend to have a sound grasp of the company's sustainable competitive advantage. The key to strategy is to understand the trade-offs. So the great investors can appreciate what differentiates a company that allows it to build a moat. So strategy and operational effectiveness are two things which the author talks about in this particular attribute. So more details are available in the paper. So moving on to attribute number 4, compare effectively expectations versus fundamentals. So many of you may be aware that Professor Michael Mauboussin has authored a book called Expectations Investing with Alfred Rappaport. So that particular book talks a lot about the expectations investing. So great investors are able to effectively compare expectations and fundamentals. So fundamentals are something which capture the sense of a company's financial future. These are reflected in the financial statements. So these are figures like sales, margins, cash flows, earnings per share, and it can be anything which is available in the public financial statement. While expectations reflect the financial performance implied by the stock price. So, expectations investing tends to look at the stock price first, and then it arrives at the implied financial performance. And great investors tend to reflect whether that particular financial performance, as implied by the stock price, is possible by the company. So, making money in markets require having a point of view that is different than what the current price suggests. So, great investors are able to compare this well without falling into common traps. So, moving on to attribute number 5, think probabilistically. There are few sure things. So, this chapter is about the importance of thinking in terms of probability. Great investors understand that frequency of correctness may not be that important. More importance is given to how much you make when you are right versus how much you lose when you are wrong. So this particular piece, the attribute number 5, has a lot more which are covered in the paper. So which can be which is very interesting, in fact. So the great investors tend to gain exposure to positive black swans. So black swans are events which are largely unpredictable, which tend to have a lot of consequence in terms of magnitude. So positive black swans are those black swans which are any unforeseen positive development should be able to benefit the investor. So moving on to attribute number 6, update your views effectively. Beliefs are hypotheses to be tested, not treasures to be protected. So what this means is great investors are flexible in their views and thoughts. So most people tend to maintain consistent beliefs even when facts reveal them to be wrong. Great investors seek information or views that are different than their own, and they update beliefs when the evidence suggests they should. So, any new emerging piece of news or information might trigger a change of opinion in the mind of an active investor, a great investor. So, being actively open minded, which means the willingness to search actively for evidence against one's favorable beliefs, plans, or goals. So, this is an important attribute of a great investor. And the best investors among them recognize that the world changes constantly, and none of those investors hold rigid views. So, moving on to attribute number 7, beware of behavioral biases, minimizing constraints to good thinking. So, in this particular section, the author introduces the concept of intelligence quotient IQ and rationality quotient RQ. So, IQ refers to the general intelligence of a particular person. So, it could be the mental ability, whereas the rationality quotient refers to the ability to make good decisions. So these are two different aspects. So, IQ and RQ are totally different. A person can have a very high IQ, who is very good in understanding complex mathematics, but he is a very bad decision maker. So this is a classic example of a person with a high IQ and low RQ. But on the other hand, there may be another person who has an intermediate level of IQ. He's able to perform basic arithmetic and understand common things, but he has a very good ability to make decisions. So this is a person of an average IQ and a high RQ. So Warren Buffett compares IQ to horsepower and RQ to output. So IQ is what the horsepower which tends to drive an engine, but RQ is the output of the efficiency of the engine. So the great investors tend to have an ability to sidestep behavioral biases, and it is likely to be part disposition, which is by birth, part training, and part environment. And great investors are relatively less affected by cognitive bias than the general population. They tend to learn about these things and how to cope with these biases, and they put themselves in a work environment that allows them to think well. So, moving on to attribute number eight, the great investors tend to know the difference between information and influence. So, this is again loosely related to the expectations part, which I talked about earlier. So, prices can be a source of information or influence. So, to understand what is influence, the author has given an example of the dot com boom. So, dot com boom increased investors' paper wealth and influenced others who didn't own shares in dot com companies. And many of them ended up buying at higher prices. And they drove the prices even higher till there was a frenzy, and there were many people who bought at the peak only to see most of their wealth eroded in a matter of few months. So the author also gives a model called threshold model. So where he explains about the riot, So the first initial, there could be many people. So some people need one or two people to be to have started a riot, and they would be joining. Whereas a few other people need more people to be part of that particular phenomenon. So similarly, the author compares this to the influence in while investing. So great investors don't get sucked into the vortex of influence. This requires the trait of not caring what others think of them. Moving on to attribute number nine. So this is on position sizing, maximizing the payoff from the edge. There are two things which the author talks is important for sound investing. One is an edge. Edge is something like a competence. So if you have a competence to search for undervalued stocks. And second part is the money management, which involves fully taking advantage of it through proper position sizing. So essentially, this means that betting more when odds are in your favor. And proper portfolio construction requires specifying a goal, identifying an opportunity set, and considering constraints. So, common approaches for position sizing include mean variance and Kelly criterion, which are like mean variance usually tends to seek a model which optimizes the standard deviation of returns. So this is preferred by someone who is a conservative investor, who is not who doesn't want much drawdown in his or her portfolio. Whereas Kelly criterion is a model which tries to maximize the return. So there can be many approaches to position sizing. And astute investors understand that finding edge and betting on it appropriately are both essential to long term success. And the author also says that most of the investors, like including investment banks, institutional investors, they tend to focus more on the edge rather than on the position sizing. So, position sizing is one aspect which has not been given its required importance in the area of institutional investing. So moving on to attribute number 10. So this is a simple one. Which says read and keep an open mind. So the author stresses on the importance of reading for curiosity, concentration, perseverance, and self-criticism. So reading is an activity that fosters a lot of such qualities. And there is a quote by Charlie Munger which says, "In my whole life, I have known no wise people who didn't read, none, zero." So this kind of gives us the importance of reading. And great investors tend to allocate time to reading. In fact, they don't just allocate; they prioritize reading over other many activities which they can do, and they tend to take on material across a wide spectrum of disciplines. So they don't really read only on a specific industry or on the investing part. They may read about psychology, biology, astronomy, and many disciplines. And the author also says too that you should make it a point to read material you may not necessarily agree with. So reading something which you don't disagree with is an important trait of a great investor. So, this, my friends, were the 10 attributes of great investors. I would urge you to read the whole paper because the paper has many examples, and I have tried to simplify those 10 attributes in these slides. But reading the whole paper will give you a more broader perspective. And apart from the 10 attributes, the author also has a couple of other pages on which is related to improving your performance in the investment management industry. So you could take a look at this particular paper and try to inculcate the best practices of great investors. Thank you for listening.